Welcome back to Finance in Motion. My name is Adamo, your personal financial planner, and as always, my goal is to help build your wealth and help you sleep well at night. In this video, today we'll be talking about the most interesting topic of the day as we are in Canada in January of 2020, which is the refinance. Why am I mentioning this topic? Because as we know, real estate is booming in Canada, more specifically in our city here, which is Montreal. So clients will always, and people in general, always ask, how can I refinance? How can I get into real estate and buy more properties? So we hear this word being tossed around, refinance, very often. So I wanted to create a video to show you in a brief example with some assumptions how a refinance can help you continue on your financial plan using real estate and some other situations that I'll show you during the example. So as always, my videos always are as issue, action, and result. I'll take you through the example. Again, as always, my board is kind of heavy, but I'll show you each line item and go through and walk through the example together. So the initial issue is, as I mentioned, real estate boom in Quebec and in Canada. How can we take advantage of that? Unlocking home value, which is the result of taking advantage of home values appreciating tremendously. And can I use this unlocked home value by keeping my home, of course, and diversify across other assets, either real estate or different types of assets as a follow-up move. Okay, so the assumptions that I have here, I'm sorry that it's a little bit small, but I had to try to fit it into the board. We see that today's value, if I purchased a home of $500,000, in 10 years, I grew it at a growth rate of 3%. You can put 2, you can put 4. So I went with a standard conservative 3% average annual growth rate. That would have the home be worth about $670,000 in 10 years. The interest rate that I used for the mortgage is about 3%. Again, these change frequently. I just used 3% for the case of our example. I put an amortization, or the length of the mortgage term, as of 25 years. The down payment, I put 20%. I recommend that if you can, to put 20% down so that you can give yourself some breathing room down the road to take advantage of the strategy and the refinance that I'll talk about in this example. If you can't, of course, that's a whole separate conversation in terms of what down payment you can afford. But in our example, I use 20% as a down payment. Putting a 20% in Canada actually helps you avoid the CMHC insurance. So there's an insurance and a cost to putting less than 20%. But I assume 20%, which gives us on 500,000, which is 100,000 down payment. The mortgage is then 400,000, and then the mortgage balance after 10 years would be around 275,000. So if you have these numbers for our example, it will help us understand what amount of unlocked value is available to me. Okay, now play around with these numbers, change some of these numbers. It'll essentially change the results, but the strategy and the process holds true. So what's the action of unlocking the value and in the refinance play? So you're 10 years down the road, you bought your home, it was 500,000. 10 years later, you go to the bank or you go see your mortgage broker and you see what the value is at that point, and you ask, can I unlock some value? Can I refinance? So how does that process work so that you can better equip yourselves as you project these numbers before actually doing that? So the bank will essentially tell you, fine, 80% of the value or the new value of the home is what I will allow you to unlock. Okay, why? Because they keep the 20% as a buffer to protect against the default on the client's part. So they will go up to 80% of that new value, which I said was 670, 10 years from now. So that is about 536,000 of new value. Now the 670 will be determined by the bank sending an evaluator. Sometimes they don't send one and just take the value that you put. So this is always debatable, but for the simplicity of this example, we took the calculated number at 3% over 10 years. So that gives us 536 less the current mortgage that we have at that time, which in 10 years would be about 275,000 of mortgage left over. So that's a difference, or an unlockable value, of $261,000. Now, I'm sure at this point, some of you are like, wow, that's amazing. So the point here is to start with a property and let it work for you over time. But again, these numbers can change based on these changed assumptions. So if you want to be ultra conservative, use 2% as a growth rate on your property, okay, over the 10 years. I just used 3 to show you the example, okay? So how do I then access this unlockable 261,000 of value? So you want to secure that money, and you can do it in one of 2 ways, okay? One is the HELOC, so an acronym for Home Equity Line of Credit. So we are familiar with lines of credit on the personal side. This would be one that's attached to your home, okay? So this one is interesting because it has an increased flexibility, because the money would be there. The 261 in this example would be available. You're not paying interest on it because you haven't used it. The day you find an opportunity to buy another real estate property, or take some of that money and invest it in the markets, or invest it in an RSP contribution or a tax-free contribution, because that money's there and you can do with it what you will, then you start paying interest on that amount. You can then pay capital and interest if you want to repay the amount, or just pay interest only depending on what your strategy is, okay? So this one has a higher flexibility. However, in today's reality in Canada, the interest rate on this product is higher, okay? So as of today, it's around 4.5%. These numbers change, of course, but for the sake of the example of the video, in today's reality, the interest rate on a home equity line of credit is a little bit higher than a straight up mortgage, okay? So increased flexibility, but an increased cost right now. Or we can just lock that amount in a new mortgage, okay? So you would have the 275 as one mortgage, which you continue to pay, and then you would have this amount or part of it in a new mortgage that you pay a fixed capital and interest payment together, okay? So in this example, in this situation, you have a decreased flexibility because it's a regular monthly payment, but in today's reality, that rate is a little bit lower and you're paying down capital as well. So a little bit of a safer situation, but these two can be done one or the other or in combination. And you don't have to use the entire 261. You can tell your mortgage broker or your banker, I just need 100,000 from this. Lock that into the home equity or a new mortgage, and then use that money for your next property, or for your lump sum RSP contribution, or to invest in the markets, or do a home renovation, or whatever the case may be. Just make sure that whatever you do with that money, that it adds to your net worth, that it builds your wealth, not that you use that money for consumption, okay? Remember, we always pay ourselves first, and then pay others via consumption, okay? So what is the result from this? Essentially the result, why are we doing this? Again, you know my goal is always to create wealth or increase your wealth. So that 261 is now available money that you've unlocked from the brick of your home or of your investment property. You can then use that money as your down payment on your next property. You know, young clients always come see me and say, how do people do it to build a real estate empire, so to speak? How do they buy one plex and then another and another and another? What are they doing that I don't understand? Well, one of the things that they're doing, one of the strategies that they're using essentially, is that they're using this mechanism. So you buy your first property, you wait a certain number of years, you unlock some of the equity. This is again known as equity in the refinance situation. So putting some acronyms or terms in the industry. You take this equity to then use as a down payment on your next property. So you can imagine now you went from one property to two, and then you wait 5 to 10 years, and now both are increasing over time. You're paying down the loan on both. You can then refinance one or the other to buy a third, and so on and so forth. So you see how over the course of a lifetime or of a 20-year period, for example, you can really build off of this strategy and end up with the X number of doors that you're looking for in your strategy. Okay? So remember that this down payment can be part, for example, if you did want to use the full 261, you can do part of it as a down payment on a property, part of it as a lump sum RSP contribution, which helps you towards your retirement plan. You can do a home renovation, you can invest in the tax-free savings account. So there's plenty of things you can do by unlocking this value in your home. Now I suggest sitting down with your financial planner and looking at, does this strategy fit with my overall financial plan? What age am I at to be able to do this? Should I be doing this if I'm 5 years from retirement? Should I be doing this if I'm 25 and about to have my first or second child? So it's important to look at this in context, but in a vacuum like this and under these examples, this is how you would unlock some equity to then move to the next level and purchase your next property. So I hope this helped you understand the word refinance, the strategy behind it, and how you can start building your wealth through the tool of real estate. If you like this video, please don't forget to subscribe below. And as always, have a great day.